Markets moved today as investors violently reassessed a key assumption about the double threat of energy inflation and financial stability. Under the surface, today's price action demolished the Fed stability put narrative that briefly energized markets yesterday. It was a day of aggressive and indiscriminate selling, particularly in the growth sectors. The tech-heavy Nasdaq collapsed nearly 2.4%, and the benchmark S&P 500 tumbled 1.8%. The Dow, while relatively more resilient, still dropped more than 1%. This deleveraging event was triggered by two primary forces: a worsening energy conflict and a batch of economic data that fatally wounded the soft landing thesis. In the bond market, the recessionary pause narrative died quickly. The U.S. 10-year yield spiked back above the critical 4.30% level. Meanwhile, crude oil jumped nearly 2%, breaking past $104 as the physical supply shock intensified. Perhaps the most defining signal of systemic stress came from gold, which was liquidated in a 2.7% plunge. When investors dump their traditional safe haven during a crisis, it means they aren't selling what they want to sell. They are selling what they can sell to cover losses elsewhere. Energy was the sole island of safety, continuing its structural outperformance. The rest of the tape was painted red. The catalyst for this shift was the collision between a hawkish Fed, weak economic data, and an escalating geopolitical reality. First, the 5-day diplomatic pause in the Strait of Hormuz has mutated into an active conflict zone. Iran formally rejected the U.S. ceasefire proposal and dismissed claims of productive talks. This resets the narrative from a temporary pause to a prolonged kinetic conflict. It guarantees that nearly 20% of global seaborne oil remains trapped, deepening the supply crisis. This geopolitical escalation was met by a significant miss in U.S. manufacturing data. New orders for durable goods, products meant to last, fell 0.8% in February, a much deeper contraction than expected. This data confirms that high interest rates are now actively breaking the real economy, turning the Fed's higher-for-longer path into a recessionary constraint. Confirming this demand destruction, United Airlines noted that high fuel surcharges are now forcing consumers to downtrade from international leisure travel, compressing the airline's margins. High oil is no longer just an input cost. It's now reducing the consumer's ability to afford the product. Finally, the Fed's communication fractured. While some governors had hinted at stability concerns yesterday, today other regional Fed presidents stated that core inflation is not retreating fast enough. This tells the market that the Fed's inflation commitment is strong and a stability put cannot be guaranteed. Institutional money spent the day in an emergency deleveraging and liquidity squeeze. This wasn't a tactical rotation, it was a broad-based capitulation. Technology and consumer discretionary were sold ruthlessly. Duration became a toxic liability, and even the AI infrastructure hyperscalers were sold to raise cash. The defensive rotation into healthcare and stables seen yesterday was instantly unwound. Even worse, traditional bond proxies like utilities and real estate were slaughtered. Usually, these are safe harbors during a crash. Today, they were dumped because their yield cannot compete with a surging 10-year treasury. Institutions pivoted exclusively into energy. This is now the only expression of the atoms over bits trade. The primary hidden risk is the secondary energy supply cliff. Everyone is repricing a shipping freeze, but the real risk is that the physical production facilities in the UAE and Saudi Arabia are still running out of storage. Regional port storage is reported at maximum capacity. If the strait remains difficult for commercial transit for another 72 hours, regional wells will be forced into shut-ins, or physical shutdowns. Unlike a shipping freeze, a well shut-in can take weeks to reverse, even after a diplomatic breakthrough. The market is completely ignoring the geological reality of physical shutdowns. Today reflects a short-term narrative adjustment within a confirmed regime shift. We have moved past inflation concern and into systemic disruption. The divergence of oil up and gold down is the hallmark of a liquidity crisis. Investors are selling what they can to cover margin calls, not making strategic defensive bets. The central bank's inflation commitment is strong, and they are prepared to tighten into a slowdown, overriding their stability mandate. The entire macro narrative is holding its breath for the next 48 hours. The primary narrative shifter will be the regional port production reports. Any news of mandatory well shut-ins in Saudi or UAE due to lack of storage forces a catastrophic global trade repricing towards $120 plus oil. The primary confidence breaker will be the Q1 bank capital stress reports on March 27. Any surprise weakness in regional bank capital reserves will violently revive the 2023 banking crisis narrative. What this suggests for investors is that yesterday's rally was technical damage control, not a regime change. The Fed stability put is dead, and the durable goods orders confirm the economic slowdown. We have entered a liquidity scramble. Maintain elevated cash levels, hold physical assets as stagflation hedges, and prioritize insularity, defensive growth with insulated earnings over broad market exposure. The Fed stability put has expired, but the physical reality of a $100 oil regime remains the dominant constraint on earnings growth. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.